Hello traders. Today we are going to talk about an unusual indicator and an unusual strategy, which has its own advantages compared to the tools we have previously reviewed on the channel. Today we have an indicator which behaves well in flat on the range market and performs rather poorly on stable trends, on strong growth, or on a strong fall. Such tools should also be mastered because such indicators, namely oscillators, help us not only to find points of chart bounce up or down and find strong resistance and support levels, but also in trending markets helps us to find places where there may be a correction. They help to determine trend strength, trend direction, and possible trend reversal points. Today I will tell you about one of the most popular oscillators, which helps to find such points of exactly bounce from the chart. This is Stochastic. In order to install the indicator, you need to enter Stochastic in the indicator selection menu on the platform and click search, and it will appear on the screen. I recommend using it exactly with the default settings, 14.1.3. Because with other settings, Stochastic can get confused and can lag the market a lot or get ahead of it. I recommend using classic settings like this. So what is the point of the indicator? It shows us the oversold and overbought zones of the chart. The overbought zone is above the blue zone. That's the overbought zone right there. And there's an oversold zone here. What does that mean? The indicator measures the average price range of the chart for some period of time, which you specify yourself and which is specified in the settings. In this case, for 14 candles. And if at this moment the price is above the average for this period, it means that the asset is bought, that there were too many buy trades, and quite possibly this price is now approaching the resistance level, approaching the levels from which some traders will be profitable to sell. And vice versa, the oversold zone, which is at the bottom, indicates that the chart is as if it is too low relative to its average values. This means that the asset has been sold off quite a bit, and it's about time for a rebound. Support will likely be coming soon, and this price will likely be good for someone to buy right now. The classic use of the indicator is exactly like this, and the classic strategy is exactly like this. When we have both stochastic lines in the overbought zone, we open a trade down, meaning that the asset is relatively expensive. Like here, for example, we can see that it's overbought, and we're seeing a bounce back down. Next, we see two zones where the asset is already oversold, where it was already relatively low. And here we also see a few bounces upward. Here we again have an overbought zone, bounce down. There's an oversold zone here, a bounce up, and so on. You can trace that when there is no clear trend on the chart. Stochastic will show quite clearly the places where the chart will reverse. Here we go overbought again. Here we go oversold again. And here we go rebounds again. In this way, it resembles another equally famous, or rather even more famous indicator, RSI, Relative Strength Index. And let me explain the difference between the two and why I recommend using Stochastic specifically. Here's a chart of the RSI, and it works exactly the same way. It shows oversold zones at the bottom and overbought zones at the top. And when the RSI approaches oversold, we have a good buying point. That means it's a good deal to buy. And as you can see, the chart bounced at this very moment. When RSI comes close to the overbought zone, it means that we have a good entry point for trades down. There's a clear signal for a down trade here too. And also here again oversold. And again a pretty accurate signal for an up trade. Why do I like RSI less? There are 2 points. First of all, it gives signals quite infrequently. If we compare it to the stochastic chart, there are 2 to 3 times fewer signals. Secondly, the whole indicator is just a single line that shows overbought and oversold. For example, when you are in this moment, and let's say you don't see the right side of the chart, you don't know where the chart is going to go next, up or down, where it's headed, and so on. And Stochastic, first of all, gives more frequent signals, and you can use it, you can filter them of course, but you will have much more opportunities for trades. Secondly, a much more complex structure of the indicator. There are at least two lines here. The blue one is called K percentage, and the orange one is called D percentage. But this is a classic system of two moving averages. As soon as the fast moving average, in this case the blue one, crosses the orange one, it can also be an additional source of information for us. When the blue fast moving average crosses the slow one from top to bottom, it means that we have a confirmation of a down signal. When on the contrary, the fast moving average crosses the orange one from bottom to top, this is a signal for an uptrade, and we can use not only the overbought and oversold zones, but also the interaction of these two moving averages. And also being at any point on the chart, for example, here we see that the fast moving average is under the slow moving average. This means that now we have a local trend downwards. Conversely, when we would be at this point, for example, we can see that the fast moving average is higher than the slow moving average. This means we are now in a localized upward trend. So it gives us a lot more information, and we can use that. Let's move on to the problematic points. As I said, it's not a conventional indicator. The usual indicators of technical analysis show themselves well on trends. When there is a clear and understandable trend, they give good confirmed signals. But when we have a range market, when we do not have a clear trend, they work confusingly, give a lot of false signals, and so on. Here the situation is reversed. Oscillators work well, exactly and flat. But when you have a clear uptrend, like right here on the chart, we see the main problem with the stochastic indicator. As you can see, it can stay in the overbought zone for quite a long time. Right here, Stochastic showed us a signal that the chart is already overbought at this point. And in theory, we're supposed to make a trade down, but we have a clear uptrend. And as you can see, it can be uptrending for a very long time. Therefore, it is a big mistake to use Stochastic, firstly, as a standalone tool, and secondly, to enter a trade every time it shows overbought or oversold. In this case, we should have entered a trade down here. We should have entered a trade down here. We should have entered a trade down here. And they would all be wrong because we're trading against the trend, against a strong trend. Therefore, I personally suggest you this strategy of two indicators, which will help you avoid the main drawbacks of Stochastic. I suggest using it in conjunction with another indicator that will show us the direction of the trend. The simplest and most classic way to indicate a trend on a chart is to use a moving average. Even Wall Street traders use this tool. Professional traders even use a 200-day moving average with a period of 200. There's even a saying on Wall Street that bulls live above the 200 moving average and bears below it. That is, above the 200 moving average is a bullish chart, a rising chart, and when the moving average lines are below 200, it means we are in a bearish, falling trend. In order to add a moving average, we whip up an exponential moving average in the list of indicators. Here we need to change the settings, then we need to specify a period of 200 because now the moving average reacts too quickly to the price. We need to set 200 to show the value for 200 candles. General rules for using the moving average. When the chart is under the 200 moving average, we only open down trades. We only use down signals. When the chart is above the moving average, we only use upward signals. Once again, let me remind you that the down signal is the stochastic lines in the overbought zone, and the signal for uptrades is the stochastic lines in the oversold zone. So let's take a look at the strategy with a real-world example. We will use the usual signal from Stochastic for the trade, but also, as a confirmation, we will not only use the fact that we have the line in the overbought or oversold zone, they should go back to the blue zone. So the general rule for using the strategy is as follows. Pay attention to the chart. In this case, we have a chart under the moving average, so we're only looking at down trades. We are waiting for both lines to be in the overbought zone. Next, we wait for both of these slides to return to the blue zone. So we have all three signals. We have the chart under the moving average. The lines are in the overbought zone, and they are coming back into the blue zone. At this point, we open a trade down and make a nice profit. The next point, let's look at another example where we have a chart above a moving average. When we have a chart above the moving average, it means we have an uptrend and we only open trades upwards. So, on Stochastic, we are waiting for the moment when both lines enter the oversold zone. This is where it happened. Both lines have entered the oversold zone and have started to move back. Now we've got all the signals. We're above the 200 moving average. Stochastic is showing an oversold zone, and the lines are returning to the blue zone. This is where we enter a buy trade. So when you use two indicators, they will mutually filter each other's signals. You will not use false signals that are right here on this chart, but you will only use the ones that coincide with the current trend, and this will increase your chances of making good trades. Yes, you will have fewer entry points than if you just use Stochastic, but their quality increases a lot, and you can use it in combination with the moving average to look for entry points on both flat and trend charts. And in this case, it will become a universal tool that you can use in any trading session, on any time frame, on any asset. This is such a simple strategy that even beginners can master. Be sure to give it a try in your trading and share your feedback in the comments. See you in the new videos.